I still remember the morning because the numbers were so ordinary and the consequences were so large. Two brothers woke up on a Sunday and checked their investment accounts before breakfast. Same family, same upbringing, same part of the country, same rough level of income, same monthly investment habit, same amount of seriousness. And yet when they looked at the screen, it was as though they had spent the previous 3 years playing two entirely different games without realizing it. The younger brother had done what modern respectability tells a person to do. He automated contributions into broad index funds. He added a little fashionable speculation on the side because the culture always insists that you must own at least some version of the future in order to avoid feeling old. He stayed the course. He kept buying. He obeyed the script. After 3 years, he had put in almost $29,000 and opened the app expecting to feel the sort of pride that advertisements promise disciplined investors will feel. Instead, he saw a balance that was lower than what he had contributed. He had done everything correctly by the conventional checklist and still felt as though he had been mocked by the process. The older brother had invested the same amount over the same stretch, but he had not used the same playbook. His account looked radically different, not a little different, not an extra 1 or 2% different, radically different. He was not merely ahead, he had a gain large enough to change how he thought. That is a very important threshold. Most people think financial superiority is a number on a page. It is not. Real financial superiority is a change in posture. A person begins to stand differently once his money starts behaving like a helper instead of a scorekeeper. The younger brother spent that whole day trying to understand what had happened. He was not looking for magic. He was looking for betrayal. He felt as though he had been given a half-true set of rules and only now discovered what had been left out. I understand that feeling. It is one of the most common feelings in finance. The public is taught enough to participate and not nearly enough to protect itself. That is not an accident. A half playbook creates a very profitable citizen for the financial industry. A full playbook creates a more dangerous one. The difference between the two brothers was not intelligence. It was architecture. The younger brother had been taught how to survive bull markets. The older brother had also learned what tends to hold up and sometimes surge when financial conditions become truly unfriendly. That is a much rarer education. Most people are not prepared for crisis. They are prepared for optimism interrupted. That is not the same thing. A person who owns only the things that work beautifully when money is easy, liquidity is abundant, and fear is low, has not actually built a portfolio. He has built a weather pattern. Then one day the weather changes and he calls it bad luck. It is not luck. It is concentration in one regime disguised as diversification. That is the first truth I want to establish. The market is not one game. It is at least two. There is the prosperity game and there is the crisis game. The prosperity game rewards growth, optimism, technological imagination, multiple expansion, easy credit, and the broad social assumption that tomorrow will be easier to finance than today. The crisis game rewards scarcity, essential utility, balance sheet strength, flight, to safety flows, and ownership of assets that remain desirable, even when confidence begins to leave ordinary places. Most investors know how to play only the first game. That works very well for them until the environment demands knowledge of the second. Then they discover that the portfolio they thought was prudent was merely popular. That is a brutal thing to learn late. So let me tell you what I think actually happens in a crisis, not what financial television says, not the cartoon version. The public likes to imagine crashes as random attacks from the sky. One day the world is stable, then a bad thing happens and everything falls apart. That is a child's version of finance. The adult version is different. A crisis is usually a transfer, not random destruction. A transfer from one set of assumptions to another. From the assets people own because normal times flatter them to the assets people suddenly need because abnormal times expose them. That transfer has happened many times. The costumes change, the mechanism does not. The first stage is the collapse in confidence. Stocks fall, credit spreads widen. Cyclically sensitive assets break first. Anything tied to easy financing or optimistic future growth begins to suffer. People call this the crash. It is not the whole crash. It is the emotional part of the crash that the public can see. The second stage is the search. Capital does not like empty space. When money runs out of one room, it runs into another. Institutional investors, pension funds, insurers, family offices, sovereign players, serious allocators of capital, they do not get to respond like frightened retail investors refreshing their phones at 2 a.m. They need somewhere to go. Cash helps, but cash is not always enough. They need assets with certain characteristics. something scarce, something essential, something with a deep historical record of surviving monetary and economic strain. When that search begins, certain assets stop behaving like side characters and begin behaving like central actors. Then comes the third stage, the wealth transfer itself. The public is still in pain, still focused on what it lost, still hoping the old regime will return immediately. Meanwhile, the informed allocator is already buying the assets that the next phase of the system will reward. That is why some people emerge from crises altered upward, while others spend years simply trying to crawl back to even. Even is where the unprepared live. Advantage is where the prepared live. This is not theory to me. It has happened too often to be called theory. Take the Great Depression. Most people remember the broad suffering, and correctly. So stocks collapsed, banks failed, unemployment exploded, fear became part of daily life. What most people do not remember is that not all assets were treated the same. That is the key lesson. Home and broad equity wealth were devastated. But certain gold mining companies did something that sounds almost absurd when said aloud next to the rest of the period. They multiplied. An ordinary person hearing that wants to reject it because it sounds emotionally indecent. A terrible crisis should produce universal pain, he thinks. But finance is not moral in that sense. It does not distribute outcomes according to emotional symmetry. It distributes them according to positioning. One of the great gold miners of that era rose by multiples while the Dow collapsed. That is not just a story about gold. It is a story about the kind of asset the world reaches for when paper confidence is breaking and people need something tied to scarcity and monetary distrust. Gold itself matters, but the miners matter differently. When the underlying commodity rises and the extraction economics remain reasonably stable, the operating leverage can become extraordinary. That leverage is dangerous in ordinary times and astonishing in the right crisis. People ignore that because gold miners are too volatile, too cyclical, too embarrassing to own when everybody else is having fun in glamour sectors. That is exactly why they can matter so much at the right moment. Then look at 2008, a very different crisis on the surface. Housing and credit at the center, banks trembling, structured products revealing how little the clever men truly understood. The broad market was crushed, yet long-dated U.S. Treasuries appreciated, not because they were exciting, because in a panicked price, insensitive demand for perceived safety floods toward the deepest and most trusted sovereign bond market in the world. That is a very old pattern too. People say bonds are boring as though that is an argument against them. Boring is one of the best qualities an asset can have when the world is on fire. The public likes thrilling assets in calm years and suddenly develops a taste for tedium when stress arrives. This too repeats when fear becomes real. Dignity returns to boring things. A long treasury bought before the panic can appreciate in exactly the period when most people discover that they do not have enough in their portfolio that likes the same conditions. Again, this is a playbook problem. The younger brother knew the prosperity playbook. He did not know that long treasuries sometimes behave as one of the most powerful flight to quality assets in deflationary or credit. Heavy downturns, he assumed bonds were simply sleepy yield tools for old people. That assumption cost him. Now let us talk about farmland. Farmland is interesting because it offends the modern investor's preference for abstraction. The modern investor wants frictionless ideas, themes, tickers, momentum, conviction in sectors he can pronounce without dirt on his hands. Farmland refuses all that. It is physical, local, seasonal, unromantic if you did not grow up respecting the ground, but it has two characteristics I admire deeply: scarcity and utility. They are not making more productive farmland. Population does not stop needing calories because technology became fashionable. And unlike many financial assets, productive land can throw off cash yield while retaining intrinsic usefulness even when markets are distressed. That combination matters a great deal. It is one thing for an asset to survive. It is another for it to survive while still feeding you. During difficult financial periods, productive land often benefits from exactly the things that hurt paper wealth. Inflation can lift commodity prices. Fear can increase the appeal of tangible real assets. And the simple fact that people keep eating gives the owner of good farmland something a great many paper investors quietly lose: negotiating power. The world must still come to the field. That is worth more than people realize. Then there are consumer staples. This is perhaps the easiest category to understand, and for that reason, often the easiest to overlook. People hear staples and think boring. They should hear durability. The ordinary consumer may postpone the vacation. He may delay the appliance upgrade. He may cancel the streaming service he barely watches anyway. He does not stop buying detergent. He does not stop buying toothpaste. He does not stop buying food, beverages, cleaning products, and a long list of familiar goods that sit so close to daily life that their importance is invisible in prosperous times. This is why I love businesses that own what I call habitual necessity. A product can be humble and still be extraordinarily valuable if the customer keeps returning under a wide range of conditions. A great staple company has brand, distribution, habit, pricing power, and sheer repetition on its side. In a crisis that matters, the broad market may fall hard. The staple company may fall less, recover faster, and continue paying, while the world remembers which businesses actually belong in households instead of on dream boards. This category will not usually give you the cinematic surge of a gold miner in the perfect setup. That is fine. Not every protective asset has to be explosive. Some just need to be sturdier than the crowd expects. And sturdy is a wonderful trait when the rest of the market begins acting fragile. Now, if you step back, you can see the deeper pattern. The four categories the older brother had learned to own were not random. They were all expressions of the same underlying logic: scarcity, essential, utility, historical crisis, demand. Gold miners tie you to monetary distrust and scarcity. Long treasuries tie you to panic demand for sovereign safety in deflationary or credit stress. Farmland ties you to food, land scarcity, and cash, generating real assets. Consumer staples tie you to daily human need and habitual demand. The younger brother had a portfolio built for optimism and habit. The older brother had a portfolio that included a second language. And in finance, being bilingual matters. There is another reason most people miss this. The financial industry is built to make money during ordinary participation, not during intelligent repositioning. A broad market index fund held forever is a wonderful instrument in the right context. I am not one of those people who sneers at the S&P 500 as if broad ownership of American business were somehow foolish. That would be ridiculous. But what is also ridiculous is pretending the S&P 500 alone is a complete answer to every macro regime, every monetary environment, every credit event, every inflation shock, and every deflationary panic. That is too convenient to be true. The public was sold one sentence: buy the index and hold forever. That sentence works beautifully in many environments. It does not absolve you of the need to understand regime behavior. It does not give you a crisis playbook. It gives you long-term participation in a prosperity engine. That is different. The problem is not that the index is bad. The problem is that people were taught the index is enough. Enough is the dangerous word. Enough for what? Enough for 3 decades of generally declining rates, technological ascent, and expanding multiples. Perhaps enough for every crisis, every inflationary phase, every debt problem, every deflationary scare, every policy misstep, and every commodity shock. No single answer deserves that sort of worship. The younger brother had been given a good tool and a lazy religion built around the tool. That is what hurt him. He did not need a new Messiah. He needed a broader map. People are always looking for a hot new answer. I am usually more interested in the old answers that people ignore because they are too unglamorous to sell well. Crisis assets are hard to market in bull markets. That is the first reason nobody owns enough of them. The second reason is emotional discomfort. Owning gold miners, farmland exposure, treasuries, or staples during a roaring speculative market can make a person feel old, defensive, and out of sync. He sees his neighbor making faster money in whatever the latest momentum machine happens to be. He begins feeling left behind. That feeling is extremely expensive. It pushes people out of useful caution and into decorative participation. One of the oldest mistakes in finance is demanding that every part of the portfolio win every season. That is childish. A serious portfolio is a team, not a choir. Different players are there for different environments. You do not ask the fire extinguisher to entertain guests during dinner. You ask it to work when the kitchen changes character. Crisis assets often look like dead weight in the wrong year. That does not mean they are wrong. It means they are not there for the wrong year. This is why timing and sizing matter. You do not build a whole life around crisis assets and pray for disaster. That is not sensible. You also do not own none of them and pray that modern finance has permanently abolished difficult regimes. That is even less sensible. You build a portfolio that can breathe in more than one climate. That is the right idea. The source text you gave me pushes hard on the notion that these assets do the same thing. every major crisis going back 100 years. I would phrase it more carefully. No asset behaves identically in every episode. History rhymes better than it repeats. But the family resemblance across major dislocations is strong enough that only a fool would ignore it. Gold-linked exposure, long sovereign duration in the right kind of downturn, productive land, and staple cash flow businesses all belong to the older language of capital preservation. Modern people mistake older language for obsolete language. That is a very bad habit. The world advances technologically, human fear, food demand, scarcity, and flight to safety behavior remain impressively traditional. Now let us return to the brothers, because stories work best when they end in structure rather than moralizing. The younger brother, after his ugly Sunday morning, did what intelligent pain sometimes forces people to do. He stopped asking who was right on the internet and started asking what kind of environment each asset was built to survive. That is a much better question. He did not go crazy. He did not sell everything on Monday morning and hide in a bunker full of gold coins. He did not decide the market was a scam. He did not decide the economy was doomed. Those are childish overreactions. Instead, he slowly admitted something much more useful. His portfolio had only been trained for one weather pattern, so he began building a second layer, a modest allocation to gold miners through a broad miner basket and some select large operators. A measured position in long treasuries, because he finally understood that bond duration can be a weapon in a deflationary scare rather than just a sleep aid for retirees. Farmland exposure through public vehicles, because he did not have the capital or interest to go buy acreage directly. And consumer staples through both individual names and a sector basket, because he wanted businesses that would still be invited into households when optimism left the room. This matters. He did not abandon the prosperity game. He simply stopped pretending it was the only one. That is maturity. People hear defensive positioning and imagine fear. I hear versatility. I hear strategic literacy. If you are preparing only for the environment you enjoy, you are not an allocator of capital. You are a hopeful participant. Hope is cheap. Versatility costs thought. I want the thought. The text also makes a point about recession signals such as the yield curve, credit spreads, and unemployment trends. Those are worth watching, but not because I believe in performing macro prediction as entertainment. Prediction is the most overrated form of market confidence. The useful role of those signals is not that they tell you the exact day or month to panic. Their role is that they force you to ask whether the cost of remaining one-dimensional is too high. A yield curve inversion, then steepening, credit spreads beginning to widen, labor markets losing their easy strength, commercial real estate starting to wobble, consumer balance sheets getting uglier. These things do not mean you must become a prophet. They mean the environment is no longer entitled to your lazy assumptions. That is enough. The rich do not always know the future. They are often simply better at refusing to let one favorable regime define their whole imagination. That is why family offices, old fortunes, and patient capital often look dull to the public. Dullness is underrated. Dullness is frequently what remains after the unnecessary risks have been removed. The younger brother had confused excitement with sophistication. The older one had accepted a more boring truth. Protection is not glamorous until the day it is priceless. I have always believed one of the great advantages of being older is that you become less interested in being entertained by your own portfolio. You want it to work, not to flatter your appetite for speed. The ordinary investor, especially the younger one, often wants the portfolio to validate him socially. He wants to own what sounds current, what wins conversation, what implies that he understands the future. That desire is toxic. A portfolio should not be a personality costume. It should be a machine. And machines deserve different parts for different jobs. Some parts spin fast. Some absorb shock. Some hold steady. Some only show their value when the whole room gets dark. Those parts still matter. In fact, they may matter most. Now, I want to say something carefully because people always misuse these conversations. This is not a case against broad index funds. It is a case against one-dimensional thinking. It is not a case for predicting every crisis. It is a case for admitting that crises are old enough, frequent enough, and structurally repetitive enough that pretending they are unpreparable acts of God is lazy. It is not a case for hiding entirely in defensive assets. It is a case for making sure the next time prosperity is interrupted, you are not discovering from scratch that your portfolio had never learned the crisis language at all. That is the mistake. And because this is still, at heart, a Buffett-style lesson, let me put it in a way I trust. A portfolio should be able to survive your ignorance about the exact future. I do not know when the next major drawdown comes. I do not know whether the next stress will be driven by credit, inflation, geopolitics, policy error, or some absurd corner of leverage the public currently thinks is too boring to matter. What I do know is that fear does not ask your permission before it changes flows. And when flows change, the same few categories often rediscover their importance. This is why I care about positioning more than theatrics. The younger brother had been bleeding while doing everything right according to the pamphlet. The older brother had been prospering because he owned assets built for the chapter after the pamphlet stops working. That is the real lesson. Not that one brother was smarter, that one brother had inherited or learned a deeper map. Jake and Mike could have gone on living very different financial lives for another 20 years based on that one Sunday, and what it taught or failed to teach them. That is how meaningful these structural lessons are. People think the great dividing lines in finance are stock picks, secret information, unusual intelligence, or special access. Sometimes the dividing line is simply whether you were taught one game or two. If I were building a serious portfolio for an ordinary person today, I would still want broad productive ownership. I would still want American enterprise. I would still want quality businesses. But I would also want explicit respect for crisis behavior, some gold-linked exposure, understanding its violence and cyclical nature, some long-duration sovereign protection, understanding it is not for every inflationary episode but very powerful in the right credit, heavy or deflationary panic. Some real asset exposure tied to land, food, and productive scarcity, some staple ownership tied to necessity, pricing power, and the dull strength of habit. And I would size these, not emotionally, but structurally enough to matter, not enough to turn the whole life into a bunker. That is the balance. The text you gave me insists that almost nobody owns these assets. Whether the exact percentage is 1.3% or 1.9% is less important to me than the broader truth beneath it. The crowd always underowns what feels old until the old suddenly becomes useful again. That pattern will not stop merely because the apps are prettier. Now, modern packaging has not abolished ancient human reactions. People still panic, institutions still seek safety, scarcity still matters, food still matters, habit still matters, the long sovereign bond market still matters. That is why these categories remain worth understanding. And understanding is really the whole point. I do not want you worshiping a new set of tickers because one story sounded persuasive. I want you seeing the architecture. Once you see it, you begin asking better questions. What in my portfolio loves easy money too much? What in my portfolio survives disorder? What in my portfolio depends on confidence? What in my portfolio benefits when confidence collapses? What in my portfolio is real enough that the world would still want it under strain? Those are adult questions. A portfolio built around adult questions tends to survive more climates than a portfolio built around fashion. That is enough for me. The brothers taught each other something important that morning without meaning to. One taught what happens when you own the half playbook sold to the general public. The other taught what happens when you quietly prepare for both chapters of the cycle. I know which education I prefer, not because it is more dramatic, because it is more complete. And in markets, completeness is one of the few real advantages that remains available to ordinary people willing to think harder than the crowd. That advantage is still there. Most people just are not looking for it in the right places.